There is a building in Lower Manhattan, 23 stories, glass, steel, no signs out front. Inside that building, on a normal Tuesday afternoon, a group of people you have never heard of decided to move $400 billion. Not steal it, not lose it, move it. By the time the market closed, your pension had shifted. The company you work for had a different cost of borrowing, and a government somewhere had quietly revised its economic outlook. Nobody voted on it. Nobody announced it. It just happened. That is Wall Street. Not the TV version with the ticker tape and the shouting men, the real one, the one that actually runs things. And today, we are going to explain exactly how it works. Simply, honestly, without flinching. First, let us be clear about something. Wall Street is not a villain. It is not a hero either. It is a system, a very old, very powerful, remarkably efficient system that most people never fully understand. And that gap in understanding, that is by design. Right now, in 2024, there are roughly 10,000 hedge funds operating globally. The top 10 of them manage more money than the GDP of Japan. One firm, BlackRock, manages assets larger than the entire economy of Germany. These are not banks. They are not governments. They are private. And yet they influence interest rates, corporate decisions, political policy, and the price of the food you buy. So how did we get here? How does it actually work? Start at the beginning. At its core, Wall Street exists to do one thing: connect people who have money with people who need it. A farmer in Ohio needs a loan to buy equipment. A retiree in Florida has savings she wants to grow. Wall Street is the middleman. That is the origin story. Clean, simple, useful. But somewhere along the way, the middlemen got very, very good at their jobs. So good that the middleman became more valuable than the farmer. Here is how it evolved. Step 1. Companies need capital to grow. They cannot get it all from banks. So they sell small pieces of ownership, called shares, to the public. The public buys those shares hoping the company grows and the shares become worth more. That is a stock market. Simple. Step 2. Brokers emerge to facilitate these trades. They take a small cut every time. Volume grows, the cuts add up. Step 3. Someone smarter than everyone else figures out that you can make money not just from stocks going up, but from their price movements, from volatility itself, from options, derivatives, futures, instruments that are not companies, not products, not things, just bets on the behavior of other bets. That is when it gets interesting. The uncomfortable math, the hidden mechanism. The derivatives market today is estimated at over $600 trillion. Let that land for a second. The entire global GDP, every country, every economy combined, is about $100 trillion. The derivatives market is 6 times larger than the real economy it is supposedly built on top of. This is not fraud. This is not illegal. This is just the logical endpoint of a system that rewards complexity. Here's the mechanism. You have a mortgage. That mortgage gets bundled with 1,000 other mortgages into a product. That product gets sold to a fund. That fund uses it as collateral to borrow more money. That borrowed money buys more products. Each step, someone takes a fee. The original mortgage, your house, your home, is now a component in a financial instrument 12 layers removed from anything physical. And the people managing those 12 layers? They are not thinking about your house. They are thinking about the yield spread between 2 derivatives and whether to hedge it with a currency swap. It's not personal. That is the point. In 2008, the system broke. Not because of greed, though there was plenty of that. Because complexity had outrun comprehension. Nobody fully understood what they owned. Nobody knew where the risk actually lived. When it unwound, the losses were socialized. The banks were bailed out with public money. The architects of the crisis were largely fine. And then within a decade, the system rebuilt itself even larger. Hype versus reality. The contrast. Here is what you are told. Wall Street is the engine of capitalism. It funds innovation. It creates jobs. It lets ordinary people invest and build wealth over time. All of that is true. Here is what you are not told. The average holding period for a stock on the New York Stock Exchange is now less than 6 months. Algorithmic trading firms hold positions for fractions of a second.
High-frequency trading accounts for somewhere between 50 and 70% of all daily equity volume. The market that was designed to fund long-term business growth is now primarily a venue for short-term speculation by machines. And yet, public pension funds, retirement accounts, your 401k, they are all in the same market, playing by the same rules, competing against systems that can execute 10,000 trades per second. The game is not rigged. That would be too simple. The game is just played at a speed and a complexity level that structurally advantages the people who built the game. Big implications. Here's the part that matters most. Wall Street doesn't just move money, it moves incentives, and incentives shape behavior at every level of the economy. When a company is publicly traded, its executives are often compensated in stock. That means their financial incentive is not to build a great company over 20 years, it is to make the stock go up now, this quarter, before the earnings call. Research and development gets cut, workers get laid off, buybacks replace investment. All of it is rational within the logic of the system. At the government level, the same dynamic plays out. Politicians are acutely aware that economic pain, falling markets, rising unemployment, costs them elections. That means policy is constantly calibrated not just against economic reality, but against market reaction to economic reality. The tail wags the dog. And the people holding the tail? The major asset managers, the large institutional investors, the sovereign wealth funds? They are increasingly the same players, cross-owning each other's shares, voting on each other's boards, coordinating not through conspiracy, but through the simple fact that they all want the same thing: stable, rising asset prices, forever. That is a coherent goal. It is also, in the long run, mathematically impossible. The unresolved question. There is an argument that says none of this matters to you, that the market will keep going up over time, that if you just invest regularly, stay the course, do not panic, you will be fine. There is evidence for that argument. There is also an argument that says a system this large, this complex, this disconnected from the underlying reality of wages and goods and actual human need cannot sustain itself indefinitely. There is evidence for that one too. The honest answer is that nobody knows which argument wins, not the economists, not the fund managers, not the regulators. What we do know is this: the system that moves your money, prices your home, funds your retirement, and quietly shapes the decisions of nearly every large institution on Earth operates largely outside your line of sight. Whether that is a problem depends entirely on how you think things are going. The building in Lower Manhattan has no sign out front. It doesn't need one.